When do you hit the bid? When do you pull the trigger? When does Charlie Evans say, we better raise the rate this meeting? We're looking at an April meeting. We're looking at a June meeting.
You know, one thing for all the, students in the audience, in a world of finance, there's sort of, fair value pricing, what are, what's the stock value supposed to be, and then there's what it actually is. And sometimes it takes a time period to get there, either going up or coming down. What I have, in my assessment of appropriate monetary policy is that given the economy and what we're looking at, it would be 2 rate hikes this year. It's not really critical when those 2 rate hikes take place. I guess I would sort of say, one in the middle of the year, one at the end of the year. Could it move earlier? Could it move later? Could you get another one in there? It depends on the data. If we get a stronger employment report, if unemployment continues to fall, and inflation picks up, then we could get that. But April, June, July.
But witness, he just said the middle of the year, that's June. So we're going to take that as a more likely that it's June than April?
Well, that was, if you have to, another time path would be September and December. Or it could be any particular meeting. It doesn't have to be a press conference. But my goodness, the chair does a good job explaining what we do when she has a press conference. So it's an opportunity if that's what you're going to do.
You're forecasting 2 to 2.5% GDP growth this year, and that would be in line with last year's 2%. But the economy only grew in 1.4% in the fourth quarter. And then we got a big consumer spending report this week. January and February numbers weaker than expected. Consumer spending very important, so much so that the Atlanta Fed cut its GDP forecast from 1.4% to 0.6% for the first quarter. A lot of people are saying you're looking at 1% in the first quarter, President Evans. What's the risk to your forecast? If the economy falls short and doesn't accelerate for you, will you argue for a lower funds rate path for a longer period of time, or a more aggressive approach?
Well, for my own outlook, the numbers that you just cited don't really push that outlook around very much. I would say that the consumer is a strong fundamental for growth this year. Yes, it does look like the most recent retail sales and monthly consumer expenditures have been a little bit weak. We tend to think that's transitory, though. The Atlanta Fed number that you mentioned is their GDP Now forecast, which is a purely statistical forecast, takes all the data. That's a good, piece of information to be looking at, but judgmental information and thoughtfulness, could easily push you to be a little more optimistic about that. But I'm, more optimistic about the middle of the year, second quarter, and beyond that, even if the first quarter is a little weaker. So I've already got only 2 rate increases, so right. I don't really have a lot to that's already got a lot of accommodation.
But what's going to be at the inflow? If we start the year at 1% and you're looking for 2 and 2.5% a year, do we have to have at least 3% quarter?
Well, we'd have to have above, above average. Yeah, no, that's right. That's right. So, we're going to be getting by the middle of the year more information. That's why I kind of focused a little more of the attention on, the middle of the year. If the inflation data, which most recently a couple of months have been firmer, if that continues to hold, then there might be greater reason to have confidence that it's sustainable at a higher level. I kind of worry about that, but sure, it's all part of looking at the data.
What's your view on negative interest rates? The Fed has discussed and pretty much rejected them, as the Bank of Japan took a major step in that direction, and recently the ECB followed suit. What is the alternative if for some reason growth doesn't accelerate, the economy remains at something like a stall speed and looks like it could even head lower? Would you then look for negative rates for the U.S.?
So it's definitely the case that if you look around the world, as you mentioned, the Bank of Japan, the ECB, the Swiss National Bank, the Riksbank, they have been working very hard to overcome disinflationary trends and to get inflation up to their objective. They've provided accommodative policies, and in many cases, well, in all those cases, they actually have been charging negative interest rates. Now, I think you want to look at this and say, we don't want to be in this situation. I have said for the last many years that one reason to keep our eye on the 2% inflation objective is to make sure we get up to 2%. Because if you underrun 2% and then you find yourself at this lower level, then the economy stalls. Well, Japan has been in that situation for the last 20 years, and we've known you don't want to repeat that.